Alright, Crypto Millennial here. Today I've got another video for you in the Avalanche space, this time on a project called Yeti Finance. I'm going to provide an overview of this project, how it works, and exactly what Yeti Finance is about. Nothing in this video is financial advice. It's purely created for entertainment and informative purposes to hopefully give you the information around Yeti Finance so that you understand it, how it works, and can do more detailed research yourself. With all that said and done, let's get stuck into it. Yeti Finance is soon to launch. They're currently in the final stages of their testnet. Testnet first started mid-February time, and once that final stage of the testnet has been completed, mainnet will launch. Mainnet was scheduled to launch March 29th, so very soon to when this video will be uploaded. However, the team had some sickness, so this has been pushed back by a few days. I think it's important, for these launches to go smooth, so I'm personally not against that at all. And I'm very excited to experiment with this platform when it goes live. So what is Yeti Finance then? Essentially, Yeti Finance at its simplest terms is a decentralized borrowing protocol built on the Avalanche blockchain that allows users to borrow up to 11 times against liquidity pool tokens, staked assets, for example, liquid AVAX, or base assets like wrapped ETH. And also, you're going to be able to get over 20x in yield-bearing stablecoins like DAI and USDC. But we'll go through what the various collateral is later on in the video. Those loans are all going to be at 0% interest rate, so you don't pay any interest on the loans for how long you have it out. Key thing is that users are going to be able to retain all the farming and staking rewards. So basically, you're not going to be required as the user to sell out of your liquidity pool and open up a separate line of credit. You can deposit that as collateral, keep that open while leveraging Yeti Finance. So that's quite big. There's not really anything like that at the moment. And when you open up a loan on Yeti Finance, you receive YUSD, which is basically Yeti Finance's stablecoin, which is pegged 1-to-1 to the US dollar. And this is what users can use to purchase additional assets, hedge their position, provide liquidity, that sort of stuff. But yeah, basically whatever you deposit as collateral onto Yeti Finance, you'll get back this native stablecoin. I've heard on some of the AMAs as well that they're kind of pitching this as the native stablecoin for AVAX. So that'll be interesting because, we don't have anything like that right now. And a lot of the times we're using DAI or USDC. So yeah, that'll be interesting. And then I think the other key feature, which is different on Yeti Finance's protocol compared to platforms like Compound and Aave, is that you're going to be able to cross margin when you're borrowing because you don't have to set up separate lines of credit. What you can do is use a large majority of your portfolio as collateral all in one loan rather than having to open up separate lines of credit against that loan. What that does basically is makes your loan less volatile, so decreases the chances of you getting liquidated because you're going to have perhaps 4, 5, 6 assets made up in that loan rather than just taking out a loan against Avalanche. Potentially one of your coins is down but the other is up. That could balance it out and mean that you don't get liquidated. Like I mentioned earlier, loans are paid out in the Yeti stablecoin, and when you've got a loan open, you need to always maintain a minimum collateral ratio of 110%. What this basically means is if your minimum collateral ratio drops below 110%, Yeti Finance will liquidate your loan. So basically, if you were to take out a $10,000 worth of loan, you would need to put up $11,000 worth of collateral. Examples of collateral that can be used on Yeti Finance's platform are some of these I mentioned earlier, but wrapped AVAX, ETH, wrapped BTC, Linky, Joe, staked assets on XJoe, Trader Joe and Curve liquidity pool tokens, collateral that's on the Benshi platform, Aave and Banker Joe lending markets. So yeah, that's all really exciting. And like I said previously, the liquidity pool tokens on Trader Joe that's used for collateral, you're not required to sell those at all. You can just keep those open, earning those rewards whilst also using it as collateral for a loan. The key benefits then you as the user will get when using the Yeti Finance platform are as follows. So you're going to get that 0% interest rate that I talked about earlier on any debt that you take out on Yeti Finance. So you as the borrower will never ever pay interest on any loan that you take out on Yeti Finance. That minimal collateral ratio of 110%. You're also going to be able to use your yield bearing assets like we discussed to generate extra yield while accounting for your collateral value. So those liquidity pool tokens on Trader Joe, for example, are not required to be sold by you. You can still have them in there earning, but also can be used as collateral in Yeti Finance. And also your YUSD, so the stable coin for when you get a loan, is always going to be redeemable at face value of $1 whenever you need it at any time. And then also finally the portfolio borrowing. So rather than having to take out individual debt positions or individual loans, you can just take one big loan out against your portfolio to hopefully hedge against spikes in the market to reduce your risk of potentially being liquidated. The two tokens then that are used in the Yeti Finance ecosystem are the YUSD, which is the stablecoin we talked about, and there's also going to be a Yeti token, but we're going to talk about that more in the tokenomics section. But essentially there's two key tokens in the Yeti ecosystem. And then lastly, regarding fees on Yeti Finance. So we said earlier you don't pay any interest on any loans, but regarding fees, there's a few different types of fees. The first one is a one-time deposit fee. So when you deposit any collateral into Yeti Finance platform, you're gonna pay a fee on that. And there's also a one-time borrowing fee. So when you create a debt position, there's going to be a slight fee with that. Also, there's a third fee called redemption fee. So at any time that you redeem your YUSD for collateral, you're going to pay a variable fee on that amount of money, which says here is a minimum of 0.5%, and that these redemption fees are likely to increase during periods where lots of people are redeeming and demand's high. On borrowing then, if you've read the documentation, you would see mention of this trove word quite a lot. A trove on Yeti Finance is basically just where you take out and maintain your loan. It's linked to your Avalanche C-chain address and obviously is locked in a smart contract when you set one up. It's similar to like a vault from other platforms, and basically that trove will consist of your multiple different collateral types that you use to set up a loan on Yeti Finance. And you can kind of in that interface see the different amounts of collateral you've got, what the value is, what your collateral ratio is, and how that kind of evolves over time, and monitor that. How you can borrow with Yeti Finance then is, like I said earlier, you need at least a collateral ratio of 110%. The minimum amount you can borrow on Yeti Finance is $2,000. So if that was the case, you would need to put at least $2,200 worth of collateral to take out a $2,000 debt in the Yeti stablecoin. Obviously, it's not advised to always put the minimum amount of collateral down, because you could get instant liquidated if there was a turn in the market. So if you can, it's always advised to keep your collateral ratios healthier. But obviously, that's your decision. You can decide exactly what you want to do regarding collateral rates. Onto the tokenomics then. Yeti Finance utilizes a two-token system. So Yeti USD, YUSD, which is the USD stablecoin I've talked about. You should be clear on that now. And then additional to that is a Yeti token, which is the protocol token. This captures the fee revenue generated by the system, incentivizes early adopters, and you're going to be able to stake this, etc. And there's maybe plans for this to transition into a governance token like it says here. The Yeti token then has a 500 million maximum supply, and there's a few ways that you're going to be able to earn Yeti. So you could stake your stable coin in the stability pool to earn Yeti. You could provide liquidity on YUSD Avalanche pools on Trader Joe and be rewarded in Yeti token. You could also provide liquidity for the Yeti Avalanche pool on Trader Joe, or provide liquidity for YUSD on Curve. So there's going to be those few ways that you can earn Yeti through rewards. How to get Yeti and YUSD then? Yeti Finance is doing a fair launch. Obviously this doesn't apply to the stablecoin. I'm talking specifically about the Yeti token. So when the token launches, this will be available on Trader Joe DEX, so you'll be able to buy it from there and swap it directly, or you'll be able to farm it using the methods that we just went through. YUSD then is pretty straightforward. You can get it by obviously taking a loan out, or you can also then swap directly through a DEX as well. When you've got a loan open then on Yeti Finance, this is what your dashboard will look like. It's quite a clean, simple to look at interface. You've got your borrow summary on the left, your pool summary, and your stake summary. So in your borrow summary, you'll be able to see your collateralization ratio to see if you're getting near that threshold and manage that. You can see the total amount you've borrowed, and you can see this VC number in dollar value. And basically what this is your virtual coin value. And this is a calculation that's done by Yeti Finance, and you can read more about it in the documentation. But basically it's the safety ratio, which is a number between 0 and 1.1 for stable coins, or 0 for 1 for other collateral, times by the token amount, times by the token price in USD. And then you can also see a list of your tokens, the wallet balance, what the Trove balance would be. So yeah, you can really manage your loans and give you all the information available to decide what you want to do and prevent yourself from being liquidated. The final thing then I want to go through is a comparison that Yeti Finance has done against Magic Internet Money. I'm sure you've heard of it, Abracadabra, that project, to really weigh up the features so that you can understand the differences between the two protocols. So regarding leverage then, Yeti Finance offers up to 11x and sometimes 21x for stables like we talked about. Abracadabra only offers 5x leverage. Borrowing, you're able to borrow against your entire portfolio. I think this is one of the biggest selling points for Yeti Finance, as it hasn't been done before. Abracadabra, like I talked about previously, and they're not the only ones that do this. Other protocols only allow you to take individual loans against assets, not all as one, which means you're vulnerable to being liquidated in market swings. You can't hedge with different assets because they're all their own individual loans. Interest then, Yeti Finance is interest free, like I said. Abracadabra, however, increases with the time that you borrow it. Stablecoin peg mechanisms then. Key thing with these lending protocols is users always want to have that confidence that they know that they're going to be able to trade in their stablecoin for the equivalent amount in dollars. Obviously, sometimes with current protocols, this requires the team to intervene a little bit to keep that $1 peg. What Yeti Finance is saying that they're going to do in their platform, and I guess we'll see whether the proof is in the pudding, but there's going to be a hard peg mechanism to keep that to $1, and that you're always going to be able to redeem it at that rate. The way that they do this is that if it ever trades above $1.10, there's a hard arbitrage opportunity that mints $1 worth for 1.1 of collateral and sells it back at a profit, thereby bringing the price down and increasing the YUSD supply. So this is all done in the protocol, doesn't require team's intervention. I guess we'll just have to see how this plays out, but I think that's quite an innovative strategy that should hopefully allow that stable coin to keep pegged to the $1. And then finally, regarding centralization, obviously MIM is run by the MIM team, the central bank. Yeti Finance, on the other hand, is decentralized. That's it from me then. I hope you enjoyed the video on Yeti Finance. Obviously different to some of my previous NFT videos, but I think you're going to enjoy this one. Let me know if it was useful in the comments down below. Share with your network. Also like it. Appreciate that. Wanted to try and make the video as short and sweet as possible. Lending protocols can be really complicated when you get into the weeds, but I just wanted to break it down into simple terms for you. If Yeti Finance is something you're interested in, I'll definitely urge you to go read the technical documents for yourself so you can understand how it works, what capital would be at risk. Thanks very much for watching. Speak to you soon.